In the beginning of entrepreneurship, you're so afraid of hearing no. But the reality of it is that you need to be hearing no more than you hear yes to know that you're being appropriately priced.
When you get Alex Hormozi, Cody Sanchez, and Daniel Priestley in a room, you're not just getting advice, you're getting a masterclass in the operating systems of wealth. I've just gone through their entire conversation, and there's one strategic lever they all touch on that separates the businesses that struggle from the ones that scale effortlessly. It all comes down to one question. Are you trading your skills on the highest return market possible? Let's start there, because this is the single biggest mindset shift you need to make.
The final component is risk, and that's the one that I would multiply everything by, which is how much risk do you take on.
People often say this idea of selling to the rich, but as you explained it there, what it actually sounded more like is sell to the person who's going to yield the most returns from your skill. And I reflect on this because I spent the first half of my career doing social media marketing. And I think I said this when we sat down, Cody, that I used to work with fast fashion companies or fashion companies, and the net return for the client of me selling them more dresses was tens of thousands. I then left that business and spent 2 years working in psychedelics in the biotech industry, where if this was around the meme stock thing, where if they could galvanize people on social media to care about their stock, the upside, the swing, was billions of dollars.
This is the core principle. The example of the conversion rate agency is perfect. The same work, the same skill, the same hours create 100 times more value when applied to a larger business. This isn't about selling to the rich for the sake of it. It's a strategic decision to apply your effort where it generates the highest possible return. This allows you to charge more, which means higher margins, which means more cash to reinvest in growth. It's a virtuous cycle. Most entrepreneurs are stuck competing in low-value environments, fighting for scraps. They think the path to more income is more work or more clients. The real path is moving your existing skill set to a better market. It is the single most powerful form of leverage you have. You don't need to learn a new skill. You need to find a new buyer. Of course, charging premium prices requires a level of conviction that most people starting out simply don't have. So how do you build the confidence to actually ask for what you're worth in these high-value markets?
I think when you're starting out, a lot of times you sell out of your own wallet, to Cody's point. So it's like you have no dollars in your wallet, so you assume everyone else has no dollars in their wallets either. And you're so afraid of getting rejection that you continue to lower the price until you hear people say yes. But just as like a benchmark for people who are starting out is that like usually you're appropriately priced when 7 out of 10 people are saying no. That's like about the appropriate price. So if you have if I see a business and they're doing 80% close rates, as in like 80% of the people they talk to say yes, they usually have a double or triple in pricing just sitting there. If they're at like 60% close rates, they usually have a 1.5 to 2x price increase that's sitting there. If they're at 40 to 50, they've got a 50% price raise in there. And if they're right at that 30-ish, 35%, then they're usually appropriately priced. And if they're at 20, they just need to learn how to sell better. But but fundamentally I say this because usually, in the beginning of entrepreneurship, you're so afraid of hearing no. But the reality of it is that you need to be hearing no more than you hear yes to know that you're being appropriately priced. Because
This is a profound reframing of rejection. He is explaining that no is not a failure. It's a data point. If everyone is saying yes, it's a clear signal that your price is far too low and you're leaving a catastrophic amount of money on the table. Your close rate is a thermometer for your pricing. An 80 to 90% close rate doesn't mean you're a great salesperson. It means you're a terrible pricer. It feels safe, but it's a direct path to burnout and business failure because your margins are too thin to survive. I see so many entrepreneurs who are terrified of hearing no, so they price themselves based on their own bank account and fear. The real strategy is to treat pricing as an experiment. You systematically increase the price until you hit that sweet spot, that 30% close rate. This isn't about arrogance, it's about gathering market data. That data is what gives you confidence. Confidence isn't a feeling you wait for, it's something you build by collecting evidence that the market will bear your price. This all works if you have a viable business idea to begin with. You can't just slap a high price on a bad idea. So how do you know if the fundamental model is sound?
What we use that comes from private equity, if you want to know if your business is going to make you money or not, or investable or not, we use the MOAT strategy, which is basically M stands for margin. So you want a business that actually makes you money, doesn't just generate revenue. And so a good business typically has at least 15% net margin. So that's the money you put in your pocket, right?
So that's profit.
Yeah, exactly. And then the O stands for operations. So operations being, can this thing actually scale over time, or will I really have a job, not a business?
And what's the difference there?
The difference between the two is if you have a job, not a business, that might be, for instance, without AI, if my entire business was just me talking continuously to camera and I'm an actor, it's really hard to turn acting to a business, right?
You're trading time.
Right. You're still an employee, you're just self-employed as opposed to a business owner. And there's a real difference between a CEO and a self-employed person. And then the A stands for advantage, which is, do I have an unfair advantage in my business?
The exact mental model that private equity firms use to decide whether to invest millions. You should be using it to decide whether to invest your time, which is far more valuable. Let's break it down from a wealth strategist's perspective. Margin is first for a reason. A business without healthy profit margins is a trap. It's a high-effort, low-reward job. Operations forces you to answer the question, can this business run and grow without my direct involvement in every single task? If the answer is no, you haven't built a business. You've built yourself a job. Advantage is your defensibility. What makes you different and hard to copy? Is it your brand, your network, a unique skill? And finally, TAM, the total addressable market. Are you fishing in a pond or an ocean? This framework systematically de-risks your entrepreneurial journey. It forces you to think like an investor in your own idea, not just a passionate creator. Once you have this high-margin, scalable business, the next thought is often about creating passive income. But that's a term that gets dangerously misinterpreted.
So first, I think it'd be helpful for everyone to even define in terms of how to think about passive income versus active income. So one is that people often discuss it in binary terms, passive versus active, when it's really more of a continuum of how passive is it versus how active is it. And that way it becomes way less black and white. When I think about passive versus active, when people are starting out, I generally just discard it entirely because they typically don't have sufficient capital in order to actually make meaningful passive income, and they would get significantly higher returns on increasing their active income. And virtually every extremely rich person who's self-made, as my asterisk, generally has gigantic active income and only begins to look at passive when they have so much money from reinvesting in their higher return things, which is what got them this very large active income, that they're like, where else should I put it? And then at that point, it's really a question of diversification, which is like, how much more do I not want to double down on the main thing? And that's a completely personal question. And there is no, in my opinion, there's no right answer to that.
Mm-hmm.
This is one of the most important clarifications in the entire discussion. The obsession with passive income is a trap for beginners. It's a wealth preservation strategy, not a wealth creation strategy. As he says, when you're starting with little capital, your highest return will always come from investing in things that increase your active income. What does that actually mean? It means investing in skills that make you more valuable. It means buying equipment, like the snowblower example, that gives you leverage on your time. The reframe to performance assets is also critical. Instead of thinking about passive income, think about building assets, intellectual property, media, code, a client list, that can generate income without your direct time input for every dollar earned. You build it once, and it pays you repeatedly. The goal isn't to do nothing. The goal is to decouple your time from your income by creating leverage and building assets. Chasing passive income from day one is a distraction that will keep you from ever building the active income required to have anything to invest in the first place. So much of building those assets today revolves around content and brand. But just making content isn't enough. You have to build genuine influence.
And so in order to create influence, there's four things. So number one is, and so I just remember SPCL, right? So you have status. So somebody who controls scarce resources. So a bartender at a bar, there's alcohol behind them. It's a scarce resource. In the bar, they have status. When they walk outside of the bar, no one cares about them. But in the bar, they have status, right? So they give influence. The second is power. And so power is basically say-do correspondence, meaning if I tell you to do something, follow these instructions, and a good thing happens, then I'll increase the likelihood that you comply with requests in the future. And so, like, for example, Martha Stewart was the first self-made female billionaire, and I think there's a huge amount of reasons for that. And one of the biggest ones is that she literally gave people recipes, and they followed the recipes, and they had a good thing happen. And then people told them they were great, and this cake was great, and this lasagna was amazing. Their family, their friends, they also got status. So a massive good thing happened after following explicit directions. And so then when she said, follow my next directions and buy this thing, people said, okay, the last 10 times I did it, it worked.
This SPCL framework is the blueprint for monetizing attention in the modern world. It explains why a TikToker with 50 million followers can have failed product launches, while an educator with 50,000 followers builds a multi-million-dollar business. Attention without influence is worthless. Let's look at this strategically. Status. Do you control access to something people want? Information, a network, a platform? Power. When people follow your advice, do they get a positive result? This builds trust and is the foundation of any education business. Credibility. Do you have the proof, the results, the case studies to back up your claims? Likeness. Do people see themselves in you? This isn't just about demographics, it's about shared values and experiences. Most people online only focus on one of these, if any. But if you intentionally build content that demonstrates all four, you create a powerful bond with your audience. They don't just watch you, they trust you. And when you have trust, you have the ability to convert attention into action, whether that's a sale, a subscription, or a referral. This is the difference between being a creator and being a business owner. With a solid idea, the right pricing, and influence, the final piece is turning an interested prospect into a paying client. That comes down to the pitch.
So it's like, don't do that. Just get 10, and on your 11th, you'll be able to charge 10 times more because you'll be able to say, hey, look at the 10 people that I helped. And realistically, you'll get more out of that than they will because you probably suck.
Yeah.
So it's probably for everyone's best interest that you don't charge anything. But from an actual like closing perspective, and I'll talk about this from appointments, I think to use Daniel's language, I've taught the closer framework for a very long time, which is CLOSER. And so C is clarify why they're there, which is, and typically anybody who's going to be in that appointment has taken some action. So whether that's they responded, to a post, they commented, they liked, they actually, if someone's already set an appointment, or they walked in the door, like there's always something, like, why'd you pick up the phone? Like there's always some reason, like, why'd you give me 5 seconds? There's always something they've done that you could say, hey, so tell me why, right? And so then you're clarifying why they're there, why they're still listening.
His point about getting your first 10 clients for free is counterintuitive, but brilliant. You're not trading your time for free. You're trading it for your most valuable asset, proof. That proof is what allows you to charge 10x more for client number 11. It's a short-term investment for a massive long-term payoff. Then he gets into the closer framework. This is a system that turns sales from an intimidating art into a repeatable science. Clarify why they're here. Label their problem. Overview what they've tried before. Sell the solution. Explain away their concerns, reinforce their decision. The power of this framework is that it puts the customer's problem at the center of the conversation. You're not talking at them, you're diagnosing their situation with them. It transforms you from a pushy salesperson into a trusted advisor. For anyone who feels uncomfortable with selling, adopting a system like this is a game changer because it provides a clear, logical path to follow, removing the fear and guesswork. Ultimately, what this entire conversation reveals is that building significant wealth is not about finding a single secret. It's about systematically stacking these frameworks, a framework for your idea, for your pricing, for your influence, and for your sales process. The common thread is that you have to stop thinking like an employee and start thinking like an investor in your own time and energy. Where can you apply your skills for the highest leverage? What frameworks can you use to de-risk your decisions? Let me know in the comments which of these strategies you think would make the biggest difference for you right now. And if you got value from this breakdown, like and subscribe for more.